J.P. Morgan was sitting on the board of directors. So he made decisions which benefited J.P. Morgan and himself because he owned 3 million shares of stock. Okay? Now, that's a felony. Now, in fact, Senator Dodd was asked on a radio show, what does he think about that? And he says, it doesn't look kosher to me, and I'm going to ask him about it at the hearing on April the 3rd or the 5th or whenever it was. But Senator Dodd didn't ask Jamie Dimon about it when he had the chance to. You see? So that's the guys who were involved in the takedown of Bear Stearns. You see, there was so much money. Now, this $55 billion is interesting because it was collateralized by the unencumbered assets of Bear Stearns. Now, how can you be bankrupt if you got unencumbered assets worth $55 billion, which the Federal Reserve Bank of New York is willing to take as good collateral for making a $55 billion loan that lands in the hands of J.P. Morgan? Well, how can Bear Stearns be broke when they have unencumbered $55 billion of assets? Okay? Because J.P. Morgan didn't put up any assets to make that loan. They made a $30 billion loan based on collateral from Bear Stearns, 29 of which is non-recourse. In other words, you don't have to pay it back.
So it's really a gift.
Yeah, it's a gift. $29 billion was a gift to J.P. Morgan. Plus, they made a loan to Bear Stearns for $25 billion, which went to J.P. Morgan. So J.P. Morgan got flushed with $55 billion, and they actually bought Bear Stearns at a bankruptcy price. You see? So this was, in my view, planned because they couldn't pull this off in a matter of days. You see? And I think it was planned months ahead of time. And then anyway, I talked about that in my meeting, my article. I wrote that article, and that article I kind of updated it a little bit from what I sent you.
You mean it's called Bear Stearns Buyout, 100% fraud?
Yeah, that's right. That's right. That went all over the world. It was I saw it translated into about 6 different languages.
You should download this, everybody listening. Download that article and go to optionsforemployees.com. Now, John.
Yeah.
How many trades a day did you used to make, roughly?
When I was trading as a market maker in Chicago, I was trading about 100 trades a day, which averaged about 30 contracts. So I was trading like 3,000 contracts a day. And for that was probably when I was in Chicago, maybe a little less at other times. But I probably traded more options in more diverse situations at that time than anybody. But again, that goes way back. But those were the days when it was easy to make money, and as an individual with not too much cash yourself. Whereas nowadays you're playing against guys that have tens of billions of dollars, and they can do what they want.
Do you miss it?
Well, I miss it. I miss the money, but it's a lot of tough work, and it's not there now. There was days I thought I could always come back and be a market maker and pick up the same money, but it's not there anymore. And there's a lot of real, people who made good money in those days can't do it now because of it's just highly efficient. And some people think there's a good bit of insider trading taking place. They're very careful to disguise their insider trading. You see, before options were created back in 1973, before the secondary market in options was created, and before the build-up of all the volume they have now, insiders, to make a big hit, had to get a big move on the stock. In other words, if you knew something was going to happen, whether they were going to have good earnings and the stock was going to go from 31 to 33, well, that's not that big a deal, okay? Whereas nowadays, you have all of these options out there. They can make a lot of money even if the stocks don't move at all.
How's that possible?
What they do is they sell what they call straddles, or we call them premium sellers. They sell puts and calls, and if the stock just sits there, the value of those things erode over time. And they can make money even when they know the stock is just going to sit there. And so the whole expansion and proliferation of options, that is, these listed options, provides a vehicle where insider traders can exploit a lot greater than it used to be, say, 40 years ago, okay, when you didn't have listed traded options. And so, in other words, if you're a market maker now with billions of dollars, and you're tied in with Goldman or Morgan Stanley or Citigroup or Merrill or whatever, most of those investment bankers have a good rapport with the CEOs and the CFOs of the companies that they're investment bankers for. And they're not going to, the CEO and the CFO, they're not going to develop something that they're going to announce without the investment banker to know ahead of time. Okay? And so if they know that there's nothing in the works for the next 3 months, and there's, nothing's really going to happen to the company because, earnings are about expected and, this and that. We don't see any real movement in the stock. Well, if that's the case, they tell that to the investment bankers and they're market makers, and they go sell the premium. In other words, they make money by trading on that inside information, and the stock doesn't even move. You see? Now, on the other hand, if they have under negotiations of where there's going to be a buyout, the stock's going to jump from 30 to 45 or something like that, what they'll do is they'll go take off their short puts and their short calls and their and get away from that position that was dependent upon making money was dependent upon not getting a big move. Okay, so they just take that away and they go ahead and maybe reverse it a little bit by buying puts and buying calls, where now they'll make a profit if they get a big move. Okay, so you have a lot of in my view, a lot of cheating like that goes on. It's really hard to detect, and the SEC, they're not going to go after.
So even with the detection, there's not much in the way of enforcement or interest in that area.
Right. I think that that's the nature of the game right now, and there's a lot of interest in trading options, and brokerage firms are out there promoting options and strategies to do this and that. But most of those people that are listening to them that are not the insiders and not the market makers, they're losing money because it's just a big gambling game, and you're playing against guys where the game is fixed.
There's a lot of difficult and traumatic challenges going on around the world in geology, with weather, with infrastructure. Japan is an example.
Yeah.
It's so interesting how something starts in one place, but it's connected to something else, and then it affects something else. It's like a chain reaction of negativity. So there's got to be people poised in disaster trading, buying puts and shorting stocks. Don't you think?
That very well may be. I really don't know how to find that out.
But there's got to be. You have provided this depth of insight into what goes on and the triggers and how you can detect it and where enforceability is and isn't. So there's got to be people that are poised, that have the knowledge that you do,